Have we got more people joining? Yeah, it's time actually. We will start the webinar now. Well, again, good evening, ladies and gentlemen. Let me formally introduce myself. My name is Leslie Chua. I am a committee member of the Business Connect Interest Group. We are a community of business owners and professionals with common interests in forging our business connections, improving our business connections, getting more people to join our networking sessions, and also to pursue new business opportunities during networking sessions, and also in our various overseas business trips. I hope you can join us. If you're interested, do give us a call. Do send an email to us. You can send an email to our event organizer at fatia@nuss.org.sg. Okay, thank you. Let's proceed with tonight's webinar. Before I start, I've been reminded by our speakers that no investment advice will be given tonight, including myself. I'm not an expert. All right, I'm an interested investor in the market, obviously, but yeah, no investment advice will be given by any of our speakers. All right. This evening, our webinar will cover the opportunities and risks in investing during the COVID and post-COVID-19 epidemic. Now, the word unprecedented has been used commonly, all right, over the last couple of months, all right, since the event of the COVID-19 pandemic. Right? Governments have shut down their economies and pumped in enormous amount of stimulus. Right? Massive unemployment in the developed and emerging economies around the world have been recorded. Global travel, including intra-country travel, have been severely curtailed. Okay, so I'm sure all of us are interested in the impact of all these events. How long will the economies be shut down? Okay, what will we do, or what will we ever get back to being normal? Or what is the new normal, especially insofar as investments concerned? So I'm sure all of you have burning questions to ask. So without much ado, let me introduce our two speakers tonight. Right. First up is Mr. Vasu Menon, the Executive Director of Investment Strategy at OCBC, Wealth Management Unit. With more than 30 years of investment and wealth management in the investment and wealth management industry, Vasu started his career as an economist and investment analyst, as well as headed a large equities research team, before joining OCBC in 2000. At OCBC, Vasu is a key member of the bank's wealth panel, comprising several experts who formulate views on the outlook of the markets and asset classes. In 2017, Vasu was conferred the designation of IBF Fellow of Wealth Management, a title conferred upon industry specialists and veterans who have demonstrated mastery of a profession and amplified through top leadership and commitment to industry development. Vasu is also a frequent speaker at wealth seminars. He also shares his expertise on the economic and investment outlook regularly on the media. Yeah. Without much ado, let us welcome our first speaker, Mr. Vasu Menon.
Good evening, everyone. Thank you for taking the time to join us this evening. I will be talking about the macro outlook as far as COVID-19 and the investment outlook is concerned. So my presentation will be in three parts. Number one, I will talk about the economic fallout from COVID-19. Then I will talk about the spectacular stock market rally that we've seen in the last couple of months and what's fueled that rally and whether it's sustainable. And then I'll end up with, offering you some ideas about our investment strategy and how you can position your portfolio. So let's start with the first slide. Let's move forward. Okay. So first of all, I want to make a statement that COVID-19 has caused tremendous economic damage. And I want to share with you some of the facts behind this. We go on to the next slide. So here are some facts. Number one, the world economy is expected to shrink by 3% this year, according to the IMF. Now, how significant is that? If you go back to the global financial crisis in 2008, 2009, the IMF world economy shrank by only 0.1%. That was a very big crisis, but yet, the world economy fell by 0.1%. And now the IMF is forecasting minus 3%. So that's a very big deviation. So clearly the crisis currently is probably more serious from an economic impact than global financial crisis. Secondly, if you look at the US unemployment rate, it skyrocketed from just above 3% to about 15% currently as of April. And this is the highest reading since the Great Depression. In the Great Depression, during that period, unemployment rate rose to as high as 25%. Now, you can't discount the possibility that the unemployment rate may continue to hit higher in the second quarter of this year, perhaps even 16, 17, 18%. So unemployment has gone up significantly in the US. Now, the third fact I would like to share with you is that 36 million Americans have lost their jobs in just the last couple of months. Now, that's very, very significant because, that's equivalent to what America created in terms of jobs for the last 10 to 11 years. So in 2 months, all the jobs they created in the last 10 to 11 years has been wiped out. Now, let's go on to the next slide. Now, the other factors, other facts that you may want to take note of, retail sales in the US has plunged by a record 16% in April. Now, it's significant because the US economy is driven by consumer spending. 70 to 80% of the economy is driven by consumer spending. And you can see a huge plunge in retail sales. So that's not the best piece of news for the US economy. Next, the US economy slumped by 4.8% in the first quarter of this year. First time the economy slumped since the global financial crisis in 2009. And the markets are expecting, or rather economists are expecting the US economy to contract by 34% in the second quarter of this year. I think that's one of the sharpest corrections in US history, even more than the Great Depression. So bad times for the US economy in terms of economic growth. Now, it's not just the US that is facing headwinds. If you look at China, the Chinese economy contracted by 6.8% in the first quarter of this year. Again, to put it in context, that is the first time China has contracted, the Chinese economy has contracted in almost its entire history in the last 30 to 40 years, modern day history, I mean. Now, let's move on to the next slide. So I presented a number of very dismal, economic data. Clearly, COVID-19 has done a lot of economic damage. Now, despite the dismal economic data, markets have rebounded very sharply from the low on the 23rd of March this year. Now, in the next slide, we'll give you an idea of how much markets have rebounded by. We could go to the next slide. Now, if you look at this chart, what it tells you is that, global equities are up 29% since the low on March 23rd. US equities have been the star performer, up 32%. Bear in mind that these numbers were updated a few days ago, and I think the numbers are now even higher than 32%. European equities up 22%, Asia ex-Japan up 22%, and Japan up 19%. So stock markets have done spectacularly well, and the markets are pricing in a huge amount of optimism. Optimism that we will see a V-shaped recovery, that COVID-19 will soon pass, and we will get back to business as usual and see a big rebound. That's what the markets appear to be saying. Now, the big question that all of us have is, are the markets disconnected from reality? I've just presented reality in terms of economic data, and are the markets disconnected from reality? Okay, let's move on to the next slide. Now, what's behind the rally? I think we need to understand that before we can understand. We can talk about what lies ahead for the future. I would say in 2 words: hope and fear encapsulates the reasons behind the market rally. So let's move on to the next slide, and you'll see the factors that capture this. So firstly, we've had extraordinary monetary policy and fiscal policy from governments and central banks. Extraordinary. The U.S. Federal Reserve has done things that they've never done before in history. They pumped so much money into the system, much more than they did during the global financial crisis. The U.S. government has unleashed a massive firepower in terms of fiscal policy. The spending is just enormous. Countries like Japan, for example, have unleashed, just to give you an idea, $2 trillion in spending. That's equivalent to 40% of Japanese GDP. Something that is really unheard of. I mean, massive. Right? And monetary policy throughout the world has been eased. 65 rate cuts throughout the world since COVID-19. Several central banks, injecting monetary policy, ready to do more. I think that's provided comfort to investors that, perhaps, things will start looking better. Secondly, the infection figures have started to improve. New cases and the death in worldwide, I'm talking about worldwide, have started to plateau and started coming down. And that's partly because, there have been a lot of restrictions, lockdowns, and, it seems to be working. But of course, in some parts of the world, like South America, infection numbers are still skyrocketing. So we had the COVID-19 epicenter move from China, to Europe, and then it's moved to the US. And now it's in South America, where Brazil is in number 2 position. So we have to watch this very carefully. Thirdly, markets are very hopeful, investors are very hopeful that, economies are opening, and, so that's going to lead to a big boost in economic growth. They're hopeful for a vaccine. According to the World Health Organization, 110 vaccines are being developed, but the ones that are going through clinical trials right now are the ones that are being in China, in the US, and in the UK. And Boris Johnson is talking about, Oxford University developing a vaccine, and he's hoping that by September this year, they can give out 30 million vaccines to the British people so they can immunize themselves. It's a tall order. Fourthly, the Chinese economy has been showing signs of getting back on its feet. Industrial production in China has increased quite significantly. PMI numbers in China have increased quite significantly. China was the first to go into the crisis, and they succeeded with their lockdown in bringing infection numbers down. And the economy is now starting to get back on its feet, and that is boosted confidence and sentiment. I think finally, perhaps last but not least, what we call FOMO, the acronym for investors are fearful of missing out on the rally. Fear of missing out on the rally. That's what FOMO stands for. And there's a lot of money sitting on the sidelines, waiting for investment opportunities. And I think what we've seen in the last couple of months is, people bargain hunting, a lot of money coming in. Just to give you an idea, right? Just to give you an idea. If you look at the US, if you look at money market funds in the US, there is $5 trillion, US $5 trillion sitting in money market funds in the United States. That is a record high, even much more than, the global financial crisis. So lots of money sitting on the sidelines, retailers, institutional investors, the money market funds are funds where investors park their money temporarily until they decide what to do next. So huge amount of money sitting on the sideline. I think the other factor that has also contributed, to markets rallying is this other acronym called TINA. There are effectively no alternatives. Effectively, that's what TINA stands for, right? And if you look at the S&P 500, for example, I was just looking at the chart before I came onto the webinar. If you look at the dividend yield of the S&P 500 and you compare it with the 10-year government bond yield, the gap is now 1.3%. It is the highest gap in US history, right? Highest gap in US history. So I think investors are putting their money into the stock markets because, other asset classes don't look as attractive. Interest rates are very low. Perhaps that doesn't augur well for most bond markets. Property markets are looking toppish. Gold has done exceptionally well. Commodities are looking uncertain. So, money has to go somewhere. With low interest rates, I think investors are saying there are no alternatives. And with lots of cash sitting on the sidelines, that's making its way into the markets. So those are the factors, behind the market rally. Now let's move on to the next slide. Now, despite the strong rally in the stock markets, I think the macro picture says that it's still too uncertain right now to say with a great deal of conviction that the worst is over, right? And let's just look at the next few slides now to appreciate what this means. Firstly, the big question mark we all have is, will there be a second wave? Will there be a third wave of COVID-19? This virus has, baffled policymakers, health experts, scientists, and so on and so forth. Now, if you cast your mind back to the Spanish flu in 1918 to 1920, that's the span of the Spanish flu, it came in 3 waves. The first wave was the smallest wave, and then things eased off. And then like a tsunami after an earthquake, you saw a massive second wave, which then cooled off as well. And then you saw a third wave. The third wave was not as significant as the second wave, but it was definitely more significant than the first wave. Now, if you go on to the next slide, you will see that a study done by the Imperial College, okay, is forecasting that COVID-19 will not just disappear. It will come in waves. And these waves will go all the way out to 2021. So you will see the numbers going down and possibly picking up, and then going down again, possibly picking up. So I think this is a study done by the Imperial College. You can't discount the study altogether. So we're still trying to get a grip of COVID-19 and understand how this virus works. We're still learning, so we can't say with a lot of conviction that we will not see a second wave when economies reopen and everybody goes out there. And if they turn complacent, then it's possible that we will see a second wave or even a third wave. Let's move on to the next slide. Now, if you look at the valuations for the stock market after that huge rally that we saw, in the last couple of months, when the market saw a big sell-off in March, the valuations were attractive. Now, the price to earnings ratio for global equities is 3.5 standard deviation above the 7-year average. What's the significance of that? I think, it gives you an idea of how expensive the stock markets are relative to history. Typically, if it is 2 standard deviations above 7-year average, that results in red flags coming out. Now we're not just 3, we have 3.5 standard deviations above average. And for the US stock market, we have 4 standard deviations above average. The standard deviations are lower for Asia and Europe, where the valuations are excessive are really in the US right now. So we've had a good rally, big jump in prices. At the same time, earnings forecasts have been brought down. And so the PE ratios have actually gone up quite a lot. Next chart, please. Now, so it is too early to say that the worst is over. I don't want to be a party pooper, but I think this is something that we have to bear in mind. Still many, many unknowns. COVID-19 continues to baffle the health experts. The pandemic may not be over. There could be a second wave, maybe even a third wave. We are still trying to figure out what happens as the economy is reopened. We'll get a better idea in the coming weeks. Now, even if the economy is reopened, restrictions are still in place. It's not business as usual, for example, in the case of Singapore. And even if the government lifts restrictions, it doesn't mean that everybody's going to go out there and flood restaurants and theaters and so on. So I think psychologically, people are going to be a bit fearful as well, at least for a short while. So in China, for example, they've discovered that although in Shanghai, they've discovered that although the government lifted restrictions, many people went to work, and after work they went straight back home and not to the malls, not to theaters, not to restaurants, and on the weekends they stay at home. So it take a while before we all gain our confidence again. Next chart, please. So essentially, we think that aside from COVID-19, other risk factors to bear in mind, and it's very interesting that 68% of you, when we were polled earlier, actually forecasted that or said that you are worried about US-China tensions and that could cause the markets to pull back sharply. Something that cannot be discounted. Clearly, as we run up to the November 3rd presidential elections in the US, Donald Trump is going to up the ante. He's going to be, pushing the agenda as far as China is concerned. And I think that could scare the markets. The markets are not looking at that right now. The markets are just excited about reopening. But as we approach the second half and November 3rd, the markets could start getting more nervous. The other factor is also corporate defaults. We're starting to see that happen. The longer this virus drags out, the longer economies are not back on their feet, you could see corporate defaults. In the US, you've seen JCPenney file for bankruptcy. Here in Asia, Thai Airways has filed for bankruptcy. Hertz has filed for bankruptcy. And we could possibly see more if this crisis goes on. So our message to our viewers and also to our clients is essentially that you should tread carefully. Don't get carried away by the recent rally. Buy carefully, buy gradually. I think not to buy as well, maybe missing the boat, because if the vaccine is found, the markets will rally in a big way. So you need to be invested, but it's just that you've got to buy very carefully, buy into companies with good fundamentals, strong balance sheets, and perhaps the best thing to do is dollar cost average. Can we have the next slide? This is probably the most important slide. it's a disclaimer slide. It tells you that, we disclaim everything that we said so far. It's a necessity. I have to show you the slides. I thank you very much. Pass you back to Leslie.
Thank you, Vasu. It was really an interesting presentation. Many things to think about. Yes, and many challenges ahead. But I guess every cloud has a silver lining. Let's hope the next speaker can tell us what that silver lining is, or maybe you can share other ideas about this. Thank you. We have the next speaker. His name is Tilan Wikramashe. Now, I just hope I pronounce his surname correctly. He's the head of equity research at Maybank Kim Eng. Tilan has nearly 20 years of experience working with HSBC, Credit Lyonnais, CLSA, Credit Suisse, Arthur Andersen, advising institutional investors in equity research, IPO, secondary market funding, and other capital market transactions. With his experience and expertise, Tilan has won a number of industry awards, including Asia Money, Star Mine, and Institutional Investor, and has been featured regularly in the media, including Financial Times, Wall Street Journal, and CNBC and Bloomberg. Tilan's also spent his time as a startup mentor and an angel investor. All right, Tilan will be covering the market strategy and stock picks for Singapore and briefly on the Southeast Asia region. Without much ado, may I present our next speaker, Mr. Tilan.
Hi everyone. First of all, thanks Leslie for that introduction. Good attempt at my name. Thanks Vasu also for that well-rounded market strategy. I also want to thank NUSS for inviting me today. So I think the reality is, you've heard a lot of words like unprecedented, once in a lifetime, all those sorts of words, and I'm going to continue using them as well through my presentation. Next slide. I think just in terms of what I'm going to talk about, I'm just going to talk a little bit about where we are in the overall macro scenario, but Vasu's covered most of it, so I won't spend too much time on it. Where we see Singapore in that context and what the markets are thinking. We'll also talk a little bit about equity strategy, as well as talk about what we are thinking about around the Southeast Asian region. Next slide. Next slide. Next slide. Thanks. Unprecedented is really the way we have to describe this time. If you look at the past 700 years and you look at the pandemics that we have had, certainly current one is moving up the league tables. So, anyone who just says that this is just the flu is lying to themselves. Next slide. The good thing, and I think Vasu also alluded to this, is that generally in most of the larger markets, we're starting to see that the new infection rates are coming off. They're not falling, but at least they're getting to manageable levels. Unfortunately, next slide. If you look at Southeast Asia, this isn't really the case yet. I mean, we're still seeing overall infection levels rising, and particularly true for Singapore, Indonesia, and even Malaysia. I think the only exception here is, to an extent, Vietnam. Next slide. And this has brought about, pretty unprecedented government reactions. We've seen lockdowns across most of the Southeast Asian markets, travel restrictions on public gatherings. On the scale, Indonesia is a little bit more relaxed. Vietnam has started to open up, but pretty much most of the other countries are still on very strict lockdowns. Next slide. This obviously has a significant impact in terms of overall economic activity. In Singapore now, about 40% of the economy is in hibernation. You see a similar sort of trend in most of the other Southeast Asian countries. We're looking at about a 7% GDP contraction for Singapore this year. That's the worst in Singapore's history. And if you look at the other Southeast Asian countries, the regional powerhouses for economic growth like Indonesia, the Philippines, Vietnam, Thailand are also experiencing almost negative growth or negative growth. Next slide. And obviously this will have an impact in terms of how governments are reacting. And you see that with massive policy rate cuts across the region, and overall interest rates will remain low for a long time to come. Next slide. This is, I think this slide pretty much captures the reality of COVID-19 in a way. If you look at how the economic complexion for most of the Southeast Asian countries, there is quite a large gearing towards a sort of frontline COVID-19 impacted sectors, such as tourism, retail, transportation, and so on. And out of that, if you take Singapore and Thailand, have some of the strongest, largest contributors in this segment. So plus oil and gas as well. Next slide. So within all this, where are we in Singapore? What's the market thinking? So it's actually quite interesting. We are just coming off the first quarter earnings season, and what we saw was about 65% of the companies that reported were actually in line or better than expected in terms of profitability versus what analysts were thinking. But nearly half of those companies saw earnings downgrades by the analysts. So despite the fact that, you know, numbers came out as expected or optimistically, everyone was quite a lot of them actually saw numbers being cut on the other end. Next slide. And what we see is that from an earnings point of view, we've seen pretty much most of the major sectors have already, in the first quarter itself, already seen pretty big declines in terms of overall profitability. I mean, if you look across sectors from financials to industrials, you've seen fairly big declines in overall profitability. And remember that this is first quarter, where January and parts of February were actually still pretty okay. As we go into the second quarter, when the full brunt of the circuit breakers in Singapore, as well as a lot of the regional lockdowns will start to be seen, these numbers are going to look even worse. And as we go into the third quarter and the fourth quarter, I think unless economic activity starts to pick up and you start to see markets really opening up, you're going to see quite a lot of pressure in terms of profitability for companies. Next slide. So how is the market taking this? How are valuations and how's the overall market taking this? Next slide. This is the interesting point. So if you look at, you know, the past few recessions, from the GFC to the Asian financial crisis, you actually saw the STI actually falling about 60% from peak. Even during SARS, it kind of did that in 2 installments. But this time around, we see that the STI is only down about 20%. So what is the disparity between the reality of what we are seeing and what we are expecting to see versus where market performance is? Next slide. I think a large part of that can be explained from this slide here. This doesn't actually include the budget measures that Singapore announced yesterday, which pretty much took overall stimulus measures by the Singapore government close to 100 billion, or about 20% of GDP. But you've seen unprecedented levels of liquidity being pumped into the economies across the region. Just like Vasu mentioned about the Fed, you've seen similar sort of reactions on the fiscal side as well as on the monetary side as well. You've seen the MAS coming in terms of advising banks in terms of how they should be recognizing things like NPLs, the government stepping in to guarantee loans for SMEs. So there's a lot of liquidity that has been pumped in with the sole aim of making sure that a lot of companies kind of ride through this and come out the other end without actually suffering too much harm, and also the same thing for individuals. But the problem is whether these measures will actually work or not is unknown, because we've never seen this level of stimulus before. And if you look at the GFC and if you look at the QE that happened, generally when you pump in so much liquidity, it starts to appear in the most unthinkable of places. So I mean, I think this is something that we need to keep an eye on. This is something that we need to be extremely cautious about. And whether it'll actually work, we'll only know in a few quarters from now. Next slide. So this has kept valuations at a very interesting level. I mean, on a price to book basis, Singapore looks extremely cheap. But if you actually look at on a price to earnings basis, you've actually seen a bit, valuations have actually increased over the past few weeks. And I think partly this is driven by the fact that the market has actually cut earnings, but the prices haven't reacted. And I think this is, again, something that we need to keep an eye on. I think there will be pressure on the downside as the market starts to price in some of these risks. Remember, as I said, we haven't seen the full brunt of the circuit breakers and the lockdowns across the region yet in the numbers that companies are reporting so far. Next slide. Next slide. So, what do you do? How do you play markets like this? How do you position your investments with so much uncertainty, so much volatility? I think earlier on today I was on another forum, and this sort of question was asked for me again on whether to play the volatility. There is generally a temptation during times like this to play volatility, and some will get it right, but most will get it wrong. And I think even the traditional tools that you use from a fundamental point of view or technical point of view becomes harder to use, given the fact that things change very, very fast, very quickly over the course of the market during periods like this. So I think the primary measure that I look at is conviction. I think you need to really take into account what is important for a company to succeed. How strong is management? What is the quality of the balance sheet? Where are they in terms of their leverage? Are they in structurally growing sectors where there is a story beyond COVID-19? And I think also you need to look at alternative data. And what I mean by this is not trying to do artificial intelligence or all sorts of regression analysis. What I mean is a lot of us get stuck in our own data bubbles. We look at the same sources of data when we're doing an analysis. We use the same methodologies. But during markets like this, we really need to broaden that out. We really need to understand what is happening on the ground, talk to people, see how industries are faring, see how individuals are faring. And I think a lot of those actually provide a much better gauge of what companies to look at and conviction levels. I think from that point of view, we are looking at a portfolio for Singapore, which is primarily driven by structural growth. Where there are industries which will grow no matter what the short-term conditions are. We are looking for dividend visibility as well as diversification, particularly from a geographic point of view, and also earnings diversification as well. So from that basis, we are quite positive on a few sectors, particularly the banks in Singapore, the REITs, technology. This was one of the key sectors that most of you are already investing in, as well as a few stocks which we think are unloved and misunderstood at this point. So I think we'll drill down a little bit more into these sectors in the next few slides. Next slide. I think on the bank side, generally the Singapore banks are a flight to safety during times like this. We've seen this with GFC, we've seen this with multiple other recessions as well. And I think the banks this time around are entering this cycle at a much stronger level. Their balance sheets are strong, very high liquidity, especially the US dollar liquidity levels. Leverage ratios are low. And I think they've also been fairly aggressive in that regional diversification. So despite based in Singapore, they still benefit from some of the growth stories that North Asia as well as Southeast Asia will have once you start to see things opening up. And I think also one of the primary things that you should take note of is I think the overall funding markets will be very different when economies start to open up. More and more companies will look at moving out of China to other markets for their supply chains, particularly Southeast Asia will benefit from this. More and more MNCs and large companies will look for alternative funding sources. And I think in this sort of context, given the fact that the Singapore banks have very strong credit ratings, they're the only AA rated banks in Asia outside Australia and Japan. I think they will naturally benefit from in terms of market share and so on. And also quite crucially during the short term, the government is using them as a transmission mechanism for a lot of the stimulus measures that they have put in place. This obviously will also have a upside in terms of their overall earnings profiles as well. Very clear dividend policies for most of them. So I think the banking sector will offer some good opportunities as we go forward. Next slide. We also like the REITs, particularly in low interest environments such as these. I think our bias is towards industrial REITs, especially the ones with overseas diversification as well. I think one of the primary things to take note of is that industrial REITs, high-end tech, high-end manufacturing, data centers, things like that, will structurally move, will continue to grow. And I think the current sort of COVID episode just will make them make this growth trajectory go faster. So I think there are good quality REIT names that are out there in the Singapore market. So especially on the industrial side, we do like this sector. Next slide. We also like technology, and I think there's already quite a lot of fans for this sector here in this audience. I think there is a structural story here. I mean, I think 5G, artificial intelligence, data centers, a lot of these trends will only accelerate given what is happening on the ground today. And I think this will provide opportunities for these companies to have structural growth despite what the short-term impact of COVID is. And what's interesting is that for a lot of these companies, they're actually deemed essential services. So even the restrictions that we have had in place, I don't think will have an overall impact in terms of their performance. Next slide. There's also a few stocks that have generally been battered. I think the land transportation sector in particular, if you look at ComfortDelGro, for instance, everyone knows that the taxi side is bad. I think that's very well flagged. And I think what most people don't discount, don't realize is about 2/3 of their revenues actually come from segments where ridership doesn't actually matter at all. And they have a fairly wide geographic distribution as well. Pretty reasonable dividends going in as well. And I think if you look at the structural story, more and more governments will move away from private transportation and more towards public transportation. So I think that actually places them at a good situation in markets like this. Similar sort of story for Raffles Medical as well. They have had disruptions given the lockdowns and medical tourism being disrupted, but on a longer term, even on a medium term basis, medical tourism is here to stay. And I think they will benefit from that cycle. Similar sort of story for Genting Singapore as well. Yes, everything is shut down. Everyone knows this. I think as things open up, people will start to visit again. And I think, there is opportunities there. Next slide. I'll just briefly touch. I'm not going to spend too much time on this. I'll just briefly touch on what we like across the key ASEAN markets. Generally, in Malaysia, we are mostly looking at dividend plays at this stage, as well as some of the exporters and some of the companies that can benefit from the low oil prices. In Indonesia, we are very much focused on domestic consumption stories, as well as some of the banks which are geared towards that domestic consumption. So companies especially like VBRI and Gudang Garam. Next slide. Thailand right now is pretty much a yield market, but also you need to keep in mind about quality given the sort of volatility there is. But on a longer term horizon, I think the sort of consumer staples in that market look quite interesting. Philippines again it's I think largely driven by the consumer side, but also quite interesting on the bank side, because I think generally there's been quite a bit of movement in terms of reforms in the banking sector there. A lot of the NPLs are being talked, at least they're talking about moving them into a bad bank so that it cleans up the balance sheets of the existing banks, as well as fairly good capital levels already. I think, yeah, that's it. Can we just quickly go to the disclaimers? There you go. Please note that everything I said was not advice, so please just take note of the disclaimers here, and then we are back to Leslie.
Oh, thanks, Dylan. Well, that was another wonderful presentation. Going through Singapore, I felt as though I went on a tour. Singapore, Malaysia, Philippines, Thailand. Wow, interesting. Okay, let me just do a short summary of presentations done by our two guest speakers. What I'm hearing is a lot of uncertainty. There's still a lot of uncertainty out there. Things are not clear. We just went through Q1 results, and I think what is happening with prices moving up so quickly was largely, is my view that this is largely started because we've seen unprecedented stimulus coming from governments, and not only were these stimulus huge and significant, they came in rapid pace. This sounds like the government, our government, including governments of various places, have been well prepared, and they are willing to put a lot of money to get things back to normal. I think the second thing that helps the markets recover, in my view, is that interest rates have gone really low. I mean, the U.S. has gone down to zero, and there's talk also about interest rates going to negative. And so with really low interest rates, I think there's much more risk appetites. The other factor which I consider having an impact on markets is this news that we get quite frequently now about a life rescuing vaccine, a vaccine that will give us get us back to normal. So you heard one of our speakers says that there's more than 100 companies around the world are working 24/7 to as a race. There's really a race out there getting a vaccine to so that we can fight this disease effectively. So I think it's not all that gloomy. I think we have gone through a very well, I would say a scary situation when things were so bleak maybe 3 months 3 months back, but things have pretty much stabilized. I think businesses that have been shut down are slowly going back to reopening, and we'll see whether the second wave will come through. I'm not saying it will not, but if the second wave does arrive, I think governments will be more prepared. I think there's much more hospital beds around. There's the scientists are much more well prepared. We have pharmaceuticals such as the one from Gilead Science, right? Gilead Science, remdesivir, which has been proven to speed up recovery from this terrible disease. Okay, we have time for question and answers. I know we are rapidly coming to 7:30. 7:30 is when this webinar will end. Perhaps I can go through some of the questions and answers. Let me see. Okay. I see that we have many questions being posted, which is great. There's a lot of interest in our webinar, which is great. Let me see if I can pull out one or two interesting questions. Okay, there's this question which I also have this in mind, which talks about the recovery. Now, we've seen almost a V-shaped recovery in the US in terms of the stock markets. But do we think that, do we expect a U-shape or another shape, maybe an L? It's not mentioned here, but what do we expect for Asia and Europe? Because and in fact even China, do we expect a V-shape, U-shape, or L-shape recovery over the next 6 months or so? Can I perhaps address this question to Vasu?
Leslie, thank you for the question. Okay, Leslie, thank you for the question. It's a good question. The way the stock markets have rebounded, the markets, global equities fell by 35%, and they've rebounded by 30%. That is a V-shaped recovery, as you correctly highlighted, Leslie. So implying that the stock markets are to some extent expecting a V-shaped recovery for the economy. I'm not sure if they're expecting too much. Our base case scenario is that we're probably going to see a U-shaped recovery. V-shaped means, markets, economies go down for 2 quarters. First quarter, second quarter is going to be bad. We know that's going to be bad. And then third quarter, fourth quarter, you see a big rebound. You see pent-up demand. Everybody, goes out there buying things. Restaurants see brisk business, and businesses see brisk business, and everything just rebounds in a big way. We don't think that's likely, given what we've said earlier. Governments are still being very careful. Individuals, even without government restrictions, are likely to be careful as well. There's a risk of a second wave, so that's going to keep too much of activity at bay. And I think we think it's going to be a U-shaped recovery. Probably markets, economies see a bad 2 or 3 quarters, and then we try and find a plateau. We form a base where things go sideways, and then perhaps after that things start picking up gradually. So we see a U-shaped recovery. But of course, if we have a second wave or a third wave, then we could see what we call a W-shaped recovery, right? Perhaps a W with a longer base, not completely a 2 V's put together, but a W with a longer base. And essentially, we could see economies taking a plunge once again, and then subsequently picking up steam. So we think at this juncture, our base case is a U-shaped recovery, a gradual recovery. We're not going to see a big pickup just yet, unless we find a vaccine. Even if we find a vaccine, Leslie, and the audience, it will take time to produce this vaccine. Producing millions and billions of vaccine for the world will take months, maybe even years. And how is it going to be distributed? So vaccine development is only the first stage. So it'll take a while before the economies get back on their feet, I think.
Hi. So let me then thanks so much for the question, Vasu. Thanks so much for the answer. But I think you're right. I think interesting that you say it's going to be a U-shaped recovery. W was not was interesting as well. It means that we will probably retest. There'll be a retest of lows, perhaps. All right, going forward, if things don't turn out as we expect it to be. So, well, we'll see. So things are still uncertain. There's a lot of uncertainty, but you know, I guess we will just wait and see what's the best. Let me see whether there's another question. I think there's a question here also about China. Okay, very interesting. Say for decades, all eyes were on China. Okay, China has been a very significant player in this whole thing, right? Because it started there, the pandemic, the virus started there, and then it spread so quickly across the globe. But now they are one of the, I mean, they are like 50% open, and I understand they are, you know, slowly getting back to their feet. But the question here is that, you know, as far as China's growth is concerned, global growth is shifting towards Southeast Asia, especially because of the supply chain disruption. So a question perhaps for Thilan is that how will which markets across ASEAN will emerge as strong winners in this situation? Perhaps Thilan, you can address this question.
Yeah, I mean, I think even before this pandemic, we actually did see supply chains moving out of China as companies adopted a China +1 or a China +2 sort of strategy in terms of supply chains and supply security. I think after the lockdowns start to ease, you probably will see this trend accelerating even more. And I think, you know, in terms of countries, we saw that, you know, generally the countries that were favored were Vietnam, Indonesia, to a certain degree, Thailand, where you will see some certain sectors like automobile manufacturing and things like that have quite a bit of strength. But also, I think Singapore, from a overall global headquarters point of view. I mean, I think you know, as I said, from a banking point of view as well, this is the regional center. From a liquidity point of view as well, this is the regional center. And I think Singapore will also benefit as companies start to move outside China. I think South Asia will also benefit, particularly some of the Belt and Road countries in South Asia. But generally, I think a large part of it will be in East Asia, particularly Indonesia, Vietnam.
Yeah, thank you. Thank you for that question. I do have one more question, I think, which is quite interesting. We're talking about interest rates here. So, burning question here is: will interest rates in Singapore will interest rates in Singapore ever go below zero? Perhaps this question I ask Vasu. I mean, I can address this question to both of you. I mean, I think interest rate is a very interesting topic. So perhaps Vasu, you can take this question first.
Sure. Thank you, Leslie. At this juncture, we don't see interest rates going down into negative territory. If you look at what the Federal Reserve is saying, I mean, in the last few weeks, there have been talks about, you know, US interest rates going into negative territory, because as you know, the Fed fund rate is now close to the 0% mark, and the futures markets were pricing in negative interest rates 2 to 3 weeks ago. But what's happened in the last few weeks is that Federal Reserve governors, including Jerome Powell, the chairman of the Federal Reserve, have come out quite clearly to say that they do not see negative interest rates. They will not take negative interest rates to they will not take interest rates to negative levels. They have other means of stimulating the economy through quantitative easing, through lending programs, and other measures. So unless US interest rates slip into negative territory, it's hard to see Singapore interest rates slipping into negative territory. But one thing is clear, Leslie, I mean, as you said earlier, interest rates will remain low for a fairly long period of time until we see, you know, economic activity pick up in a big way. But whether it'll go into negative at this juncture is not our base case scenario, and we don't see it happening unless the US takes their interest rates below zero, and the Fed and all its board members have come out quite clearly to make it very clear to the market that that is not the path they want to take, and that's not the path that they see.
Okay. Thank you. What about you, Thilan? What do you think about interest rates in Singapore?
Yeah, I mean, actually, I don't have much more to add than what Vasu said, actually. I mean, I think it'll be hard to see them going negative, especially given what Fed has said as well.
Okay, I think we are coming to an end. Let me see if I can just put in one more question from the participants here. Maybe I take a question on gold. Here it says, is gold recommended as a safety hedge during this situation? I mean, with governments pumping in so much money, I see huge devaluation in currencies coming forward. Everybody is racing to the bottom. With so much money sloshing around and government printing so much money, right? So do you think gold, and for that matter, what about Bitcoin? Do you think Bitcoin is a good hedge as well, or gold? Perhaps Vasu, you want to take that call?
Sure. Okay, I'll take the question. Interesting question, Leslie. Number one, Bitcoin, we think it's too speculative. We wouldn't advise investors to go into Bitcoin. We don't see it as a mainstream currency anytime soon. We think it's very speculative, and it's very hard to justify Bitcoins on the back of fundamentals. As far as gold is concerned, it's something that we like, and we think it makes sense for investors who have some gold in their portfolio. Gold is like an insurance policy. It's a diversifier. It's a hedge against uncertainty. And gold has done exceptionally well, Leslie and audience. If you look at how gold has done this year, gold prices are up 15%, whereas global equities are down roughly about 13% since the start of the year. So you've seen gold outperform global equities by about 28%. And what's interesting is this, gold is, I think, emerging as an asset class. More and more investors are starting to see the value in gold. So it's retail investors buying gold. So demand through ETFs have increased quite significantly. I think the other thing that's contributed to gold increasing, and which could increase further down the road, but not in a straight line, of course, is that central banks have been buying lots of gold. Central banks have been rejigging their reserves. They have been de-dollarizing. They have been increasing the content of gold in their reserves. So just to give you an idea, if you look at the first quarter of this year, central banks bought 34% more gold than they did in the fourth quarter of last year. So I think central banks are rejigging. So you see central bank demand, you see retail demand, you see institutional demand, and with very low interest rates. Okay, very low interest rates, it augurs well for gold because gold offers you no yield. Interest rates are very, very low. It makes even more sense for some investors to put their money into gold. So clearly, I think gold is something that investors should put on their radar screens. At what level, I think this is something that's very subjective, but gold has done very well this year, and I think better would be when prices pull back a little bit.
Thank you so much, Vasu. Great response. So, ladies and gentlemen, we have come to the end of our webinar. Thank you so much for your participation. I really again want to thank our speakers, Vasu Menon and Thilan Vikram Ashe. Thank you. Do look out for our next webinar shortly, and